Drop everything, everyone. SWIFT just tested XRP, and this one slipped right under the radar. And guess what? Not only was XRP right in the middle of it, but so was Hedera, Quant, and Algorand, your ISO 2022 tokens. What I'm about to show you in this video changes the entire global payments game in real time. Let's jump right into it. And let me say this as clearly as I possibly can. SWIFT has already tested its ISO 2022 framework with XRP, XLM, Algorand, HAR, and Quant. Not planning to test, not evaluating, already tested. This is the moment the legacy financial rails, the systems that move trillions of dollars daily, finally acknowledge the new internet of value. And listen to this quote directly from them. It states, "Industry observers expect that by January of 2026, further integration of central bank digital currencies and tokenized assets will take place, potentially supporting new models of digital transactions and cross-net network interoperability." That is your polite corporate way of saying the world's biggest banks are preparing for a fully tokenized financial system, and XRP is sitting in the core test batch. If you're serious about getting ahead of this next major financial shift, this is exactly why I built XRP Insiders Elite. You'll get exclusive insider alerts, the mindset frameworks the wealthy actually use, and the real strategies elite investors deploy quietly behind the scenes. You also get full access to all premium research and resources. It's linked in the description below. Use code Millionaire for 10% off. This is the moment where theory becomes practice. SWIFT testing with XRP means three things that should send chills down the spine of anyone paying attention. Number one, banks are preparing for interoperability on a scale we've never seen. Number two, they are preparing for full asset tokenization. Everything from stocks to real estate to supply chain contracts becoming programmable, tradable digital assets. And number three, they are preparing for global liquidity bridges, the backbone of moving value instantly across borders and networks. This is the signal. This is the shift. This is what the XRP community has been screaming from the rooftops for years. And now it's happening publicly in broad daylight from the highest levels of global finance. Japan just added gasoline to the fire. They passed a 21.3 trillion yen stimulus package. That's 135 billion US dollars. Think about that. Governments don't inject that kind of liquidity when things are fine. This is the kind of move you make when the financial plumbing is rattling underneath the floorboards. Traders around the world are on high alert because whenever a government has to artificially support a currency, something is breaking. And make no mistake, this stimulus is not supportive or strategic. It is panic disguised as policy. It is a last-ditch attempt to prop up a system that has been held together with tape and optimism for decades. People need to understand how deep this goes. Japan is the most indebted nation in human history, 230% of GDP. They survived for decades by borrowing at near zero rates. That era is over. Inflation is rising. Bond yields are exploding, and geopolitical pressure from China is intensifying. The Bank of Japan has only two choices: raise rates and kill the debt market, or keep rates low and destroy savings through inflation. They will choose inflation every single time. But here's the part that should terrify Wall Street: the yen carry trade. It might be the most leveraged, fragile structure in modern finance. Hedge funds and institutions have spent 3 decades borrowing cheap yen and investing it everywhere else in equities, in bonds, in emerging markets, in risk assets across the planet. The true size of the carry trade, some estimate $350 billion, others say $4 trillion. No one knows. But we know this. If the yen snaps, that entire structure unwinds instantly. Last time we saw even a preview of this, Nike dropped 12.4%. The NASDAQ dropped 13%. And that wasn't the earthquake. That was the trailer. Today, Japan's 30-year bond yield hit 3.41%, the highest since 1999. At today's yields, 10% of Japan's tax revenue goes straight to interest. That is what economists call the death spiral threshold, where your debt eats your economy alive. And the Bank of Japan is meeting December 18th and 19th. If they raise rates, volatility explodes globally. If they don't, inflation goes nuclear. There is no good answer. This is not a recession scenario. This is a change of the guard scenario. When liquidity dies, capital flees to non-sovereign assets, crypto, gold, Bitcoin, XRP, Ethereum, Chainlink. And this shift is already underway. Quietly, without headlines, but unmistakably. And I want to show you something that proves how deeply smart money sees what's coming. Because while retail panics, zooms in on the 1 minute chart, and ties their emotions to green or red candles, whales are doing the opposite. They zoom out, they look at cycles, they watch structural patterns that repeat across macro environments. Back in April, Dawn overlaid Bitcoin's parabolic curves from multiple cycles, 2015, 2018, 2022, and each one lined up to converge at day 1060. And guess what? 8 months later, the pattern held almost perfectly. Everything lined up. The timing, the behavior, the structure. And the only thing missing is the same thing that is always missing at this point in the cycle: the final parabolic move in the last 60 days before day 1060 hits. And look at what just happened. Someone placed a $377 million buy order on Bitcoin. Not hype money, not TikTok money, not retail money. Nearly $500 million from someone who knew exactly what they were doing. Smart money doesn't chase hype. Smart money front runs macro shifts. Smart money positions when everyone else is afraid. And this order wasn't a gamble. It was a signal. It was a vote of confidence in what comes next. A liquidity rotation. And XRP is part of that rotation, whether people want to admit it or not. Sentiment is already shifting. Tom Lee came out and said, Ethereum bottomed around 2,500 and the recovery to all-time highs will be faster than the decline. Historically, that is exactly what happens. Panic dumps, forced sellers, exhaustion, then the slingshot. But here's where it gets important. When majors like Bitcoin and Ethereum reverse, your utility assets, your settlement layers, your interoperability rails, your digital liquidity bridges follow. And XRP sits right there. You're already seeing the early signs. Smart money is loading, retail is exhausted, sentiment is turning, and this is where everything begins tightening into one unavoidable reality. The global financial system is entering a transition so large that most people alive today have never witnessed anything like it. The institutions that once dictated the flow of value, the same institutions that ignored crypto, mocked crypto, ridiculed XRP, dismissed blockchain, are now quietly positioning themselves because they see what's coming. And whether the average investor realizes it or not, we are living inside the early stages of a structural reset. Look at the data. Tokenization pilots are exploding across the world. Every major global institution, Fidelity, BlackRock, KA, JP Morgan, HSBC, Citi, the BIS, is openly publishing documents about the future of finance becoming fully tokenized. We're not talking about theoretical research anymore. We're talking about live trials, live transactions, live settlement tests across interconnected networks. This is the part of the cycle where legacy systems are forced to evolve or die, and they know it. That's why SWIFT ran those tests. That's why banks are reinventing their messaging systems. That's why central banks are accelerating their digital currency timelines. Everything is converging faster than even the optimists predicted. But the most fascinating part is how brutally the average investor misunderstands these macro moments. People stare at price charts thinking the price is the story. It isn't. The price is the lagging indicator. The infrastructure is the leading indicator. When global infrastructure shifts, price follows violently, suddenly, and without warning. And right now, the infrastructure is screaming. Tokenization frameworks being deployed, liquidity hubs being created, interoperability being standardized, ISO networks expanding, CBDCs preparing for cross-border functionality, and blockchains like XRP Ledger, Hedera, Quants, Overledger, and Algorand sitting in the middle because they were built for this role long before the world realized it needed them. On the other side of the world, the cracks in the traditional system are widening. Japan isn't an isolated situation, it's the first domino. When a nation that size with that much global financial influence begins losing control of its monetary structure, investors flee into anything that isn't tied to government solvency. This is exactly what happened in previous macro cycles. Capital shifts out of vulnerable currencies and into assets with perceived resilience. In the past, that meant US equities, gold, and the dollar. This time, it includes crypto. Not because it's speculative, but because it's non-S sovereign, global, liquid, and unconfiscatable. The world has never had a digital asset class during a sovereign debt crisis. And the timing could not be more aligned. The yen's instability exposes something deeper, something the average person hasn't fully processed. For 30 years, the yen carry trade was the shadow engine for global liquidity. Institutions loved it because it was practically free money. Borrow in yen at near zero interest. Invest that money anywhere that offered even modest returns. Profit from the spread. It was so easy it became structural. And now the structure is cracking. If that unwinds, markets everywhere react instantly. Equities, bonds, emerging markets, risk assets, safe havens, everything. We've already seen the smallest tremors of what that unwind looks like. And even those tremors shook global markets. Now combine that macro stress with SWIFT completing tokenization tests with XRP and other ISO assets. Combine it with global CBDC development. Combine it with rising yields worldwide. Combine it with liquidity tightening. Combine it with inflation refusing to die. Combine it with institutional demand for digital real-time settlement. It paints a picture that is almost too perfect. This isn't coincidence, it's convergence. But here's something people don't talk about enough. Cycles in crypto are not mystical. They're mechanical. They move with liquidity cycles, with H-halving cycles, with fear cycles, with macro cycles. And all of those are now aligning in unison. Look at the 4-year Bitcoin cycle. Look at liquidity cycles from the Fed. Look at institutional accumulation patterns. Look at behavioral psychology. Every cycle follows a pattern. Disbelief, confidence, euphoria, collapse, despair, accumulation, disbelief. Again, right now, we are sitting between the despair, accumulation, disbelief stages, and the signs are the same as the previous cycles. Capitulation candles, panic-driven news, bearish sentiment from mainstream analysts, high-profile investors mocking crypto, retail exhaustion, and whales quietly stepping in with multi-hundred million orders. People forget that the largest gains in crypto history always happen when sentiment is lowest. Always. Not sometimes. Always. Because by the time the narrative shifts publicly, smart money is already positioned. Look at 2015. Look at 2018. Look at 2020. The pattern repeats because human psychology repeats. And the fact that whales just placed nearly $400 million into Bitcoin during this macro uncertainty is not a coincidence. It's a signal. They know liquidity will return. They know inflation will force central banks to loosen again. They know sovereign debt instability forces money into non-S sovereign assets. They know institutional testing is underway for tokenization rails. They know the next cycle is not about memes, not about hype, not about NFTs. It's about utility, and XRP is utility. Whether people accept that or not doesn't change the truth. Cross-border settlement, utility, liquidity bridging, utility, ISO standardization, utility, CBDC interoperability, utility, tokenization, support utility. And what people overlook is that these utilities don't need retail hype. They need institutions, they need central banks, they need enterprise integrations. And guess who is already being tested by those players? XRP. That's not speculation, that's documentation. Now zoom out again. Bitcoin cycles are unfolding exactly as previous cycles did. Ethereum is showing the same recovery behaviors it showed in prior macro reversals. XRP is approaching structural support zones that historically precede rally expansions. The market is behaving normally despite the fear. It's the psychology that isn't normal. People are so exhausted from sideways movement, they can't see that sideways movement is the final compression before expansion. And every compression unwinds violently. This is also why traditional analysts keep misreading the crypto market. They apply stock market logic to a market driven by liquidity psychology. Crypto doesn't move because of earnings. It moves because of liquidity floods and liquidity droughts. And that's exactly why the yen situation matters, exactly why the SWIFT tests matter, exactly why the whale purchases matter, exactly why central bank policy matters. When liquidity shifts, crypto doesn't move gradually. It moves like a snapped rubber band. And when utility assets finally catch the liquidity wave, their upside is often the most explosive because they have suppressed volatility during accumulation cycles. And here's the part that most people don't realize. We are very likely experiencing the last major accumulation window before the next structural crypto expansion. Everything is pointing to it. Macro stress, liquidity tightening, whale accumulation, tokenization testing, institutional positioning, rising geopolitical tensions. weakening sovereign currencies, strengthening non-sovereign asset narratives. It's all part of the same story, and the window won't stay open forever. This is not financial advice. When you understand how these cycles work, how liquidity behaves, how institutions position themselves long before the public realizes what's happening, you start to see the entire crypto market through a completely different lens. You stop reacting emotionally to the daily price candles and start recognizing the unmistakable rhythm beneath the surface. The signs are visible everywhere, but most people only notice them after the move has already begun. They wait for headlines, they wait for confirmation, they wait for the green candles. But by the time those appear, the opportunity is already gone. The greatest asymmetry in crypto always sits quietly beneath fear, boredom, frustration, and exhaustion. And right now, those four emotions have complete control over the retail market, which historically has always preceded the most explosive phases of a cycle. The important part to recognize is this: utility is finally beginning to matter. For years, the market rewarded hype. It rewarded speculation. It rewarded memes. But now, global institutions are stepping in, and they are not interested in memes. They are interested in infrastructure. They are interested in settlement. They are interested in tokenization. They are interested in speed, in interoperability, in liquidity depth, in regulatory compliance, in deterministic finality, in energy efficient consensus, in ISO standards, in real world integration. When the world shifts from speculative markets to institutional rails, the assets with real functionality are the ones that rise. You cannot have a global tokenized economy running on assets that were built as jokes or assets that can't handle institutional throughput. You need networks purpose-built for real finance. And that's exactly why SWIFT tested those specific assets. They weren't chosen randomly. They were chosen because they meet the requirements that global banks need. Think about that. SWIFT isn't a startup. It is the backbone of global banking infrastructure. The fact that they quietly conducted tests with XRP, XLM, Quant, Hedera, and Algorand should be the single largest wake-up call of this entire cycle. When the institutions who actually run the financial world begin testing blockchain rails, the game changes instantly. And anyone who's been in crypto long enough knows that institutional adoption always happens silently first. You never get a headline that says, "We are about to make XRP the centerpiece of global finance." That's not how it works. What actually happens looks exactly like what we're seeing now: quiet tests, pilot programs, strategic partnerships, regulatory frameworks, liquidity modeling, and then when the infrastructure is ready, the switch flips all at once. Meanwhile, sentiment indicators are screaming that retail is asleep at the wheel. The fear, the boredom, the disbelief. This is classic cycle psychology, the same emotional patterns that showed up in 2015, 2018, 2020, and early 2023 are showing up again. People are emotionally exhausted, financial media is bearish, institutional buyers are accumulating, and charts are compressing into tightening ranges that historically precede breakout expansion. You cannot script a more perfect setup than this. The timing is almost too precise. Global debt stress rising, currency instability rising, tokenization frameworks rising, institutional blockchain adoption rising, liquidity models preparing for rotation, Bitcoin cycle timing approaching the critical acceleration window, Ethereum showing cycle reaccumulation structure, and utility assets like XRP sitting in the exact positions they sat in during previous macro turning points. Take a step back and look at the bigger structure. When liquidity rotates into Bitcoin, it always rotates into Ethereum next. After Ethereum, it rotates into large cap utility assets. Every single cycle follows the same sequence, and that sequence unfolds because of how capital flows. First into the safest crypto asset, Bitcoin, then into the smartest contract layer, Ethereum, then into the networks that actually solve real problems. And once the large caps move, everything beneath them moves even more violently. Not because of fundamentals, but because capital spills over in waves. That cycle structure has already begun. The early signs are here. And if Bitcoin and ETH truly bottomed in their recent flushes, as historical data suggests, then the liquidity wave into utility assets is almost unavoidable. This is why whales are already getting positioned. They're not emotional, they're not impatient, they don't panic when Japan's bond yields spike or when the VIX jumps or when MicroStrategy's stock sells off. They view macro panic as an accumulation window. They buy when everyone else is terrified, bored, or asleep. That's why someone quietly placed a near $400 million buy order. That's why institutional inflows into Bitcoin ETFs are already ticking upward again. Smart money is not waiting for headlines. They're not waiting for the cycle to officially begin. They're acting now because they understand what the infrastructure signals mean. They understand that SWIFT doesn't test XRP unless it sees where the future is heading. They understand that tokenization pilots across banks aren't PR stunts. They're stress tests for the next financial rail system. They understand that CBDCs require liquidity bridges. They understand that utility assets with institutional alignment are the backbone of the next era of value transfer. And all of this is happening while retail thinks the market is dead. It's not dead. It's compressing. It's preparing. It's coiling. Markets don't explode after hype. They explode after boredom. They explode when people give up. They explode when patience disappears, and they explode when infrastructure aligns with liquidity cycles. The setup we have right now across macro, across crypto, across institutional adoption, across tokenization, across sentiment psychology, it is one of the cleanest alignments this space has ever seen. Most people won't realize this until after the move. They never do. They'll wake up one day and say, "How did everything suddenly explode?" But it wasn't sudden. It was all building quietly, methodically, predictably underneath the surface. And you're seeing the final preparation phase right now. SWIFT's tests, Japan's instability, whale accumulation, cycle timing, sentiment collapse, institutional positioning, all converging into a perfect storm. And if you want to position yourself intelligently for what's coming, this is the moment to get serious. If you're truly committed to getting ahead of this next wave in the financial system, then this is where you put real structure behind your strategy. If you're serious about staying ahead of the biggest shift in global finance we've ever seen, consider joining XRP Insiders Elite because it gives you something most investors never get: clarity. You'll unlock exclusive XRP insider alerts, deep dive research, and the exact frameworks the smartest money is using to build generational wealth through utility assets. Plus, full access to all premium content, so you're never guessing in the dark. It's all linked in the video description. And if you want to jump in right now, use code Millionaire for 10% off at checkout.